this. This is my personal checklist, which I made, which I got from Better Investing. This is not Randy Buss. This is Randy Buss using Better Investing Principles. Video Learning Center. Solid sales growth in a straight line. Profits growth in a straight line, 10%. Earnings per share at least 10%. Pre-tax profit, good to excellent. Return on equity greater than 15%. Low debt. And also, I've added review of the data in the data segment of the SSG, which Carmen has discussed, to make sure the last 2 quarters, the growth in sales and earnings per share are up or improving, or at least level. You don't want to get torpedoes where these sales and earnings per share are going down. So that's the front page of the SSG. You don't go to the second page unless it passes the front page. If it doesn't pass the front page, don't go to the second page. You're making a mistake. So let's talk about diversification. Oh, I'm going the wrong way. Sorry. Diversify by sector, small, medium, large, by sector, and make sure one company does not get more than at most 20% of your portfolio, but most people would say 2 times the average size of portfolio. So if you have 20 stocks, 2 times 5 is 10%. So you would not want a company more than 10% of your portfolio in a 20 stock portfolio, as an example. So this is straight from Better Investing. These tools are available in the SSG Plus. Diversify sector and industry and company size. And we want 25% small size, 50% medium, and 25% large. But I'm going to challenge that in a moment. So this is a sample portfolio that I created to look at. This is not our portfolio. This is a sample portfolio, which has stocks that are bad in it. So don't look at these stocks as like, we're going to go buy these. Some of these are bad stocks. I created this portfolio so we can find the problems from the portfolio. Diversify by size. Now remember, Better Investing says 25% large, which are growing 5 to 7%, 50% medium, which are 8 to 15%, and 25% are small, greater than 15%. But this is an unusual time that some of the largest companies, Amazon, Apple, Meta, Alphabet, NVIDIA, Power and Semiconductor, have growth rates exceeding 15%, which really wasn't very true in the past. So that's why you're seeing in Better Investing portfolios a significant more larger companies than we have in the past. Simply, they're growing better. As I would say, I would much rather have faster growing companies no matter what the size myself. So this is the sample portfolio that I created. You can see about 5% are small, 21% are medium, and large is 73%. Large is clearly too high in this portfolio. You would wish to trim this for the large company and add small companies or medium companies, because 73% is just too high. The other thing I would add is you got to be careful. You have some companies which with sales of $637 billion, where others are only $10 billion, like Lululemon. So there's a big difference in Chipotle. So some of these big companies are barely big and some are really, really big. There's a little difference there. Look at it. Better Investing recommends at least 4 sectors and 10 industries. Growth rates vary by sector, but best growth in tech, followed by healthcare. That was true 20 years ago when the book was written. It's still true now. Slow growth sectors include basic materials, real estate, industrials, and utilities, which are frequently not seen in BI portfolios. However, AI requirement for power, utilities, and selected industries are growing much faster than the past. The key thing to remember, and the reason we've diversified, sectors go in and out of favor. You had the technology crash in 2000, Healthcare crashed in 1994, financials in 2008. So you want to be over concentrated and then get caught in a crash in one of these sectors. It's happened in the past. It will happen again, I assure you, at some time. This is from my iClub. So currently, IT is 33% of the S&P 500. Communications is 10%. So that's about 43% between those two tech companies. Because remember, Meta, Alphabet are in communications. Financials are 14%. Healthcare is 9%. That's currently S&P 500 weighting. In this portfolio, the sample portfolio, we were pretty well diversified, as one could see. I don't think anything to add to that. No company should be greater than 20% of your portfolio, or no company should be greater than 2 times the average company size, as I said. So in a 15 stock portfolio, the largest company should be 13% or less. In the sample portfolio, both Costco is 19%. You need to consider trimming that. And Alphabet's also greater than 13%. Also, no company should be less than 5%. Either buy more or sell the position and move on. So here we can see percent the company. Let's see if I can move this out of the way. This is out of my way. There you go. Right here, Costco is 19% of this sample portfolio. One would certainly wish to sell some of that, trim it down, as an example, and Alphabet's 14%. We can move on from there. That's the sample portfolio. Now we get to the PERT report. And I will admit, it's taken me years to understand the portfolio report, PERT report, but I think it's the most important. There's 2 parts to it. There's the quality on the left side, which is your defense. Remember, in sports, defense wins championships. Defense wins championships in your portfolio too. The second, or the right side of the PERT report, is valuation or offense. You want to improve your portfolio projections. So on the left side, the quality, you compare the growth of sales, pre-tax profit, and earnings per share to the judgments made in your SSG. So you have to be sure your stock selection guides are up to date before you look at the PERT report. I'll get back to that. Defensive strategies protect your portfolio from losses. Basically, get your bad quality non-growth companies out of your portfolio. Value is to monitor the potential return of each stock and see if you can improve your portfolio returns. So here's a standard PERT report. Quality on the left, value on the right. When you see the magenta lines, that means that company has not met your projections in your stock selection guide. That's all that means. In this one, for example, this report was created a few years ago. I mean, Ollie's Bargain Grill was down, pre-tax profit down, sales down, Ollie's Bargain, and their earnings per share were down. So was their trailing 12 months. So that's a questionable one right there. Values on the other side, we'll get to that a little bit later. Quality or defense. First, I repeat, update all your stock selection guides. So if we do this in the club, everybody has to keep updated stock selection guides. Look for the magenta coloring for poor fundamentals. If the fundamentals are poor for 2 quarters, look at the trailing 12 months. The trailing 12 months, also on the left side, is bad. You need to consider what you wish to do with the stock. And you would need to reevaluate the stock, maybe listen to the most recent quarter report, redo your stock selection guide, and see if you wish to sell the stock. This is basically a repeat of what I just said. So this was a portfolio. This is the sample report. You can see Chipotle has multiple pink lines, and we're going to Chipotle in our PERT report later on today. Pre-tax profit was down 1%. Sales only up 7.5%, which is less than they predicted. Earnings per share up only 3.6%. Trailing 12 months only 5.2%. So you would need to reevaluate Chipotle at this time if you wish to keep it in your portfolio. Lululemon. So Lululemon was pre-tax profit was down, sales were okay, but the earnings per share were down, and their trailing 12 months were only up 4%. That was a stock that I owned, and I made a mistake, and I did sell that stock a couple months ago, basic on these principles. This is the rest of the portfolio I created. Technoglass, pre-tax profit was down, sales up 9%, earnings per share down 3.8%, but for the year they're up 20%. So we would give them a pass now. These is also a problem stock. Pre-tax profit down 2, earnings per share down 1%, trailing 12 months 4.9%. That's also in our portfolio. Research the magenta boxes. Don't make sudden rash decisions. Check the trailing 12 months. Is that okay? Then I would give it a pass. Make a decision. Sell a stock, wait it out, change your projections, but you have to do something. You have to rethink that stock. So let's go to the right side of the report, which is the offense. So this is where you want to throw the touchdown pass. So the first thing you look at is if your returns are low and your projected relative value is high, that suggests the stock is too high priced. You may wish to trim or sell the stock. I would only recall that back in 2000, many of the tech stocks in my portfolio, like Cisco and Intel, had PEs greater than 80. The SSG were screaming sell, but most, including me, did not sell, and we paid the price in the tech crash. Mostly the offense report finds great companies, but they are overpriced and need to be trimmed. This is just some of the definitions. Projected relative value is projected PE over the average PE. That's a key one. You look for yellow coloring instead of magenta on the right side, or offense side, valuation side. If it's less than 80, it may be underpriced and a buy. If it's greater than 150, it's probably overpriced and considered a sale or a trim. So in this portfolio, you could see MedPace Holdings at a projected relative value of 150, and that would need to be considered to be trimmed. Also, United States Lime was 146%. That appears significantly overpriced, even though it's doing very well. Trailing 12 months is up 31%. I would not trim that unless that was a super large part of your portfolio myself. Relative as on this second part of the sample portfolio, we didn't see any yellow flags here. So the value side, identify potential buys, give you a higher total return. You need high upside downside ratio, relative value less than 100, and a PEG ratio of 1.5. Potential sellers, low total returns, overpriced, low upside downside, high relative value. I know I'm going through this fairly quickly, but I'm trying to make sure we go through the PERT report, which is key. We'll look at it later. The summary report is where you put it all together. Puts a row of data for each stock and use it as a source for buy ideas or shopping from your own portfolio. So this is a sample summary report. SSG data on the left, name of the stock, the date, the price. SSG data on the right, current PE, buy price, sell price, upside downside, and total return. This is your portfolio data, so how many shares you own and what price they are. So it's really good. In this portfolio summary report, you can go and press right here, and it can show you in order what is your potential return for these stocks. So you may, in this portfolio, this is from 24, you may wish to sell your Netflix and buy something with a higher total return. I'm not saying it would work, but that's what this report suggests. This was from the sample report. And now I'm going to press this button right here, and you can see the total return of the lowest are Costco, MedPace, Ollie's, Lime. So you would consider selling some of these. I'm not saying you would, but you consider it a replacement with some of the higher ones. Now, the one thing you need to make sure of is you do not purchase a poor quality company like Lululemon. We've already identified fundamentally it's poor, so you would not purchase that, or Amazon, because that's likely a value trap. So just to mention that, just because it's got a high total return doesn't mean you want to purchase it. I think we've pretty much gone over this. I would say be careful to not perform unnecessary sales in high quality growth companies, the flowers of your portfolio. Allow them to grow. I personally would avoid selling a company with sales growth greater than 10% unless the price is extremely high. Let your flowers grow. Let your winners run long. Cut your losers short. Be careful to avoid a value trap. Company with deteriorating fundamentals, projected return looks good. However, example, Lululemon, remember, a dog is a dog. It needs to be replaced and not purchased. We're trying to continuously improve the quality of our portfolio. Continuous quality improvement, which is a term we have used in surgery for at least 30 years to try to continuously improve the quality of care we provide for our patients. The same thing we want to do with our portfolio. We want to continue to improve it. So this is just a summary. Number one, you need to identify the potential problems, the defense, and sell them. You need to identify some stocks that you wish to buy to improve your portfolio return. Make sure the components for a portfolio work together with your diversification. Let's see what time it is. It's not 11. This is straight from the stock by Craig. This is a presentation by Craig Beamer. I was present one time when he presented this. He is from San Francisco. He's a financial professional. He's a certified financial planner and a chartered financial analyst. So he's highly intelligent. He's been in Better Investing for over 20 years. And he talks about trimming instead of selling your portfolio. Remember, we used to own Sprouts Farmers Market. We sold it, kept on going up. Well, maybe we should have trimmed it. Just to mention, something to think about. The concept of trimming. You sell a portion of your holding, let the rest run. For example, if you have too much Costco, you still want to own it, you need to trim it down to like 2 times the average portfolio size of a stock in your portfolio. It's a lot easier to trim than to sell because you're still going to keep the stock. So why would you consider trimming instead of just selling it or letting it run? Every day an investor has 4 options: sell, buy, nothing, or trim. So this is from 21. Starbucks is 126. It's about 80 or 90 now. So you have to think about what you're going to do with your shares. Well, let's say you were trimming here. Well, if you sold outright at all these arrows, you would lose all these great gains in Amazon. If you trim, you wouldn't have as much gains as you would, but you would still have continuing gains. So you wouldn't feel bad about that. So that's so I don't want to trim. I want to keep my Amazon. Well, that's a possibility, but other stocks haven't done like Amazon. How about General Electric until just last year? JCPenney, Lehman, WorldCom. You go on and on. Companies go down. Trimming can help you control the size of your big winning and raise some cash for diversification so you don't go down with a bad stock. So let's look at some of those. Well, now, here we have the stock of BlackBerry. Oh, what incredible. Some of you had the BlackBerry phone. I had friends who just loved the BlackBerry phone. But what happened here? Right about here, Apple came out with their first iPhone, and it was history. BlackBerry doesn't even make phones anymore. Their stock has gone from about $140 a share to $10 a share. Trimming, if you would have trimmed it on the way up, even on the way down, you would have saved some of your money instead of losing 95% of your money. How about General Electric? Well, in the 1990s, it was doing so great. They had the best CEO in America, Jack Welch. Jack Welch retired right there in 2000. You can see since then, it went down about 80%. Sure, but nice to trimming in here somewhere, and you'd have some of your money to put in your other better stocks. So a summary, it's easier to look backwards and say it's been a good stock. It's much more difficult to say what's going to happen in the future. Selling is tough. People don't want to admit they made a mistake. They fear of loss and fear of regret. And this statement here all the time. I've said it before, and it's just bad. Want to get out and get even. So stock's going down 50%. It has to go up to 100% to break even. Let's think about that. Sometimes it's better just a much better company. Most of the time is. A lot of people don't want to sell. They say it's twice as hard to admit you lost money and to sell than it is to buy. I know that's true of myself. I think it's true of most people. It's a psychological issue. I have to admit I made a stupid mistake. Some reasons you would sell or trim. Let's say you identify in the PERT the company just has bad fundamentals. You need to probably just sell the company. Let's say it's kind of in between. It's got declining profit margins, but you think it's just temporary, adverse management stains, but you think it's going to turn around. Well, you could sell it or you could just trim it. The third thing and the high thing is if you have a great company, high quality stock, it's become a large part of your portfolio, you probably need to consider trimming it down. Keep it in your portfolio, but trim it so if it goes down, it won't hurt you very much. Why do you trim instead of sell? Because I want to own my stocks forever as long as they're executing. That's how I lead towards trimming. Biggest factor is the economic moat, which is a Morningstar thing. A moat is a moat around a castle. So if you think the company has a moat, like Coca-Cola, everybody loves Coca-Cola more than the other beverages. Costco has a moat because of its low prices. Same thing with Walmart. If you have a high quality wide moat company over 10 years, the annualized return is 11% versus 2.9% for no moat companies. So you would want to hold on to these wide moat companies if you could. Wide moat companies have a higher net margin of 14% versus 4% for no moat companies. You can, if you want to know, well, does my company I'm representing have a moat? Just check Morningstar. They tell you if it's a wide, narrow, or no moat company. Here's their moats: switching costs, tangible assets like patents on drugs, for example, network effect. I mean, everybody loves Apple for all the apps, so it's not just the phone. The phone's probably not as good as Samsung phones, but their network effect is huge. Cost advantage, like as I said, Costco, efficiency of scale. Competitive forces, intangible assets like Nike, low cost advantage like Walmart or Costco, economies of scale like Union Pacific. I would never buy an airline, although I've done it in the past, so I would avoid that. The presenter likes to do it mechanically in the portfolio. So he trims generally 10 or 20% when the company has become too large. So in a 15 stock portfolio, he would trim it down to 13%. He has two levers. Number one, if the company's stock portfolio weight is greater than 2 times, and the stock has gained at least 60%. In his stock club, they do it mechanically. They have a worksheet, Excel worksheet, and if it hits these two things, they trim it, the stock. How much you trim, he recommends 10 to 20%. Easier to sell small amounts, less stress. You sell a small amount, stock keeps on going up. You say, well, I still kept a large part of it. And if it goes down, you say, well, at least I sell, I put it in another stock. It just takes the stress from your thinking. Leaders do not stay on top forever. There's advantage to trimming. Remember the S shape of the company's growth rates. Trimmings can let your winners run and still put money out and put in some other stocks. Trimming should help you let your winners run and control your position. Sell when you think the future is poor. So I am going to switch to our portfolio now. And we can look what our portfolio looks like. This is South Florida Bottle Club. Right here. Here's the reports. This is our current portfolio. Now, let's first go to the PERT report. Come on, computer. Here we go. So, which one has magenta lines in it? Chipotle. We've already talked about Chipotle. We would need to consider, and this has been down for at least 2 or 3 quarters, do we wish to sell the stock or not? Some people say, well, I think it's going to turn around. That's fine, but you have to make a decision. It's showing poor fundamentals. You also note in this report that US Lime has a relative value of 154%. Now, I think this is a relatively small part of our portfolio, so I don't think you necessarily would want to trim it, but that's something you can see on this report. Alphabet, relative value is 124%. As we go to the report, you'll see it's becoming a rather large part of the portfolio. The other magenta lines, as Valencia mentioned last month, Visa, sales, pre-tax profit, and earnings this last year are not good. During 12 months is only at 4.9%. So let's look at diversification for a moment. We're pretty well spread. We do have a fair amount of tech, 25% communication and 28%. We have 53% in one of the 2 tech sectors. The S&P 500 we said was 43%. So we're up pretty high on tech. So I don't think we should be purchasing more tech now. We can consider even trimming tech. For example, Alphabet is now 19% of our portfolio. We have, let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 stocks in our portfolio. So we should not have more than 16%, and we're at 19% in Alphabet. So I'm saying we could consider selling or trimming a little bit of Alphabet. I would not sell it personally. Now, let's look at size. We have 19% small, that's good. Mediums, 23%, not 50%, but a lot of these stocks down here are very fast growers. Large is 57%. There's the diversification report. I think it's very interesting. This one puts it all together. You look at the summary report, and we can say first, The total return, which we want to be 15%, it's 14.8. So that's pretty good. That's pretty good. Now, as I said, you may wish to consider trimming some of your alphabet. Right there. First, you may wish to sell your Chipotle, which would give you basically $1,200 to put in something else. Where would you put it? Well, you would put it in something that has a high potential return. Well, Vital Farms presented last month. We only have 1% in it. We should consider putting some in Vital Farms. Netflix. It's 5% of our portfolio, but it's also tech. So we probably should avoid adding more tech right now. ResMed, pretty good, 17% potential annual return. Could add something to that. Wallace's. Taiwan Semiconductor, people don't know, has been on a tear. Plus, their earnings came out this week. They're up, I think, 38%. Just unbelievable. So anyway, I know I ran through this quick because I didn't want to use up the whole meeting. But basically, with the PERT report, you identify poor quality companies. You evaluate those companies. They've been poor quality for several quarters. You need to consider selling those companies. That's the defense. And as we talked about in the PERT report, Chipotle sticks out right there. That's the most obvious one. Fees out a little bit, but Chipotle is the one that really sticks out. This is the defense, quality. Now, if you're looking at valuation over here, US Line, that's 150, that's really gone up. Compared to our stock selection guides, and this is our stock selection guides, it's a relative value of 154. The other one is Alphabet, which has become since it's done so well, I think it was up 65% last year. It's become a large portfolio. We may want to trim, like Craig would say, trim some of it, Alphabet, or think about trimming that. Anyway. Now, I know this has been very long, but I think personally, and I talked to Valencia about this, is first, if we wanted to do this, we would have to get regularly updated stock selection guides from the partners in the club. If you're watching a stock in a portfolio, like 3 or 4 days before the meeting, you need to update it, and it would update into my iClub. Several of them are currently not updated right now. They're old. I can show you those. So if you look, see, these are the price. The reason there's a red there is the price was last updated December, November for Google. Some of them I don't think even have updated reports in them. But we would use this. This is the offense report. The only thing pink here is Viva, low total return going forward. Relative value, Netflix, whoever did Netflix last month has to link their SSG.
Randall, are you looking at something other than the PERT
I'm
report?
sorry. I'm sorry, dear. I'm looking at the portfolio defense report. Do you not see that on your screen? Oh, let me redo it again. I thought I did that. I'll stop this.
No, what we are looking at is your PERT report.
Okay, well, I'm sorry. I thought I did it correctly, but I did not. This is in my iClub. You see portfolio defense now, Barbara?
Yes.
Okay. This is the PERT report in my iClub, this club. So here, once again, you have the magenta I in the Chipotle. You have some magenta lines in Ollie's and Visa, like we've talked about. That's the defense report. The offense report, Viva shows a low total return, needs to be considered. But this report is not really valid now because several of these stock selection guides need to be updated. And as I told you previously in the presentation, you have to have recently updated stock selection guides to make the report useful. So I would say, as a club, before a meeting, like 3 or 4 days before the meeting, the individual would just have to simply update the stock selection guide. All they have to do is go on Better Investing and check their stock out, maybe not make any changes, but just update it. And then it should update into the iClub. But I think that would make our portfolio evaluation on a monthly basis easier in a lot of ways for us. But that's what just Valencia and I were thinking, but let's open up and let people discuss what their thoughts are, what questions you have. Well, Christian, you heard it twice. What are your thoughts?
Yeah, no, I think that this is excellent. It's a lot of information to
Yes.
dissect. Even for someone like us that's done a lot of these experience with a lot of these portfolio reports. I have a lot of questions like, some of those um, techniques of deciding the size of the portfolio, like slowing down to really get a grip on how you make the analysis. If it's 2 times the total, then you get like you came up with 16%. If it's the one that's 19%, you might want to trim from 19 to 16 or 15%, and little things like that. And then some of the ones that are smaller that have, less than 5%. You either want to, like, we might want to discuss, do we want to just get rid of it or add more of it and then compare it to some of the other ones so we can kind of compare. So there's a lot of, just from what you talked about and looking at our portfolio, there's a lot of things that we can do. I mean, we can compare, Chipotle to Vital Farms. Those both have less than 5%. We can discuss trimming Alphabet from 19% to say 16%. We can, look at United States line that's now 150, relative values over 150. So is it still a growth company? Does it still meet our fundamentals? Or is it a screaming still? Or do we just want to trim? And how does that relate to everything else?
I think the key thing is you want to keep your high quality growth companies, and US Lime is performing well. It is not a large part of it's 6% of our portfolio. So it's not a large part of our portfolio. So I probably would just leave US Lime alone. I don't want to, because if it was, let's say 20% of our portfolio, well, absolutely, you would want to trim some. I presented this to my other stock club, and one of my members said, "Well, I have 40% in one stock." I said, "I think we just told you what you think. This is what we would recommend at Better Investing." I think the other thing is these are principles. They won't work with every stock, but I think over a period of time, it works for the portfolio. Like you said, like you would say, well, if we trim, let's say, Alphabet, and it goes up another 25% this year, you say, oh, we made a huge mistake. Maybe yes, maybe no, because that's just one decision versus all the other decisions you also make in the portfolio. So I think it's a combination of decisions that over time does well. on an individual stock, it may be right or wrong. Like that graph we showed of Amazon, you wouldn't want to have sold Amazon forever. But then you look at, well, was it BlackBerry or General Electric or J.C. Penney? These other ones, it would have saved up me a lot of money. My portfolio would have done much better. So I think it's a combination of decisions that works well, not one or two.
And
Yes, go ahead.
I was just wondering too, is it like looking at our individual portfolios, is it our total, everything that we're invested in, like, you know, I have some real estate that I invest in, and then I have some things in my company with my job where I work, and then I have my own personal investing portfolio. And when I look at like Nvidia's gone up massively, and now that's like a large component of my individual investing that I do, but of my total whole life portfolio, it's a small portion. So I guess that's kind of where I'm at. I'm like, do I sell it just because it's a large percentage of my smaller portfolio of my individual thing that I do on this, on the side versus, in the whole picture of my investing, it's just a small component. And yet I feel like it still has a lot of upside, and I don't necessarily want to sell what I own. In fact, I consider even buying more.
Yeah,
Well-
Zelda, that's an excellent question. I think it's always different because let's just say you have 50% of your wealth in real estate, whereas I have 10% of real estate. And that's what I have, my home. And so to you, the correct answer would be maybe different for you and me. Because you say, well, the stock is only 1% of my total net worth, so it's not that important. Although I do think there's some uniformity of your portfolio to make your portfolio better and to grow better. And I've been using just the last few months these techniques and sold off some dogs. And I mean, so far it's and bought the high quality stocks that we have talked about, we presented. And so far it's been a blessing. Of course, it's been only a few months. That means nothing. But I think the key thing though is to most important is get the bad stocks out of your portfolio. I think that's because Peter Lynch likes to tell the story. He goes, somebody asked me, well, I have 1,000 shares at $10, and a friend of mine has $1,000. He bought it $2. Who could lose more if it goes to zero? They both lose the same. So stocks can go down to zero. And so I just think really this is just about your portfolio, the club's portfolio. And remember, the club portfolio is a working portfolio, but a teaching portfolio.
Yeah,
I learned so much from Better Investing
that's true.
over the years.
Yeah, and I have
Yeah.
to say too, in our club, we sold off some dogs. And yeah, the portfolio just looked immensely better. So I agree with that. So thank you.
Yeah, yeah, go ahead.
Wanted to add to that, and basically, like you had said, when you showed the overall return of the portfolio, it's currently 14.8. We're trying to seek 15. So if we use these principles, and let's say we trimmed a little bit of Alphabet, but let's say Alphabet still kept going up, but then we check our portfolio and we use that money to buy some other stocks or other things that might be on our watch list. And then a month or 2 or 3 months later, we look and now our return is 16%. Well, then obviously it worked. And so it was, even though we might have, some people might say, hey, we lost, why did we trim Alphabet and it went up? Well, did it compared to the overall portfolio, maybe that money was used for something else. So that you really got to look at the overall portfolio and the return of the overall portfolio to do that analysis. And these techniques help you to try to keep track of that to make sure that your overall return is where you want it.
Yeah, that's why you come back to the summer report. I think the PERT report helps you identify problems, particularly inequality. And then you go to your summer report, you can say, what percentage portfolio? Like, okay, so Alphabet's 19.9% right now. And it's a hold. Maybe we need to trim it. I mean, it's done very well. And we have a little bit too much tech. And you may want to put it back into one of these other stocks. So you're just trying to, and you would do is you hit total return and say, well, what are the high quality stocks in the portfolio that I would like to add to? Well, Vital Farms is only 1.4%. That's a consideration. As you know, I'm not a big fan of Vital Farms, but that's what this shows, because Vital Farms is performing well. So you might want to, and you look right here at your. You can look right here at Vital Farms. Let's see, is it in here? Yeah, right here. Look, it's doing quite well. Trailing 12 months is up 17.9%. Excellent. Pre-tax profits. Percent change, 111%. Wow. Sales up 37%. Earnings per share up 125%. So, if you use this report, that's what you're looking for. Well, we're 11:20. If there's no more questions about this, and I email this to everybody, and you can look at my PowerPoint. You can buy the book. I would highly encourage you to do the video learning centers. Look at a few of these things. You just learn so much. Those are so well done. I mean, that's a treasure trove of information right at your fingertips. You could be watching I would watch a football game and listen, watch the game with the audio off and just listen to these video learning centers. I'm amazed how good they are. So,
Randall,
yes.
you upload this presentation to the chat so the guests, because I know you emailed it to all the members, but a lot of the guests are not on our member email list. And if you if you know how to do it, to upload it here, and that way the visitors will have access to it also.
Okay, now you got me. How do I do that?
You want me to go ahead and do it for you?
Yeah, yes, if you would.
All right.
And while you're doing that, I'd like to suggest we may also want to encourage the members to consider becoming a member of the chapter of Better Investing.
Are they not already, Ann? I didn't know that.
We have guests. We have guests that are here that are not members of the organization, and I think that as a member benefit, what he's getting ready to share is a member benefit. Now we're going to share it, but it would encourage those of us who are not members. There's a 90-day free membership on the website because we do want to encourage those who are visitors to become a member, and it's free for 90 days. And even after the 90 days, I don't think I know what Randall has shared so far has far exceeded the value and the benefit that you would receive from just doing what he shared. And the money, which is less than $100 if you decide to become a member, would be worth the investment. So I just want to encourage us as a chapter and as an organization to encourage membership. Thank you.
Yeah, and I would add, you and I have been in Better Investing for years, and I think we can see what great things it's done for our own personal portfolio. New members, it's kind of hard to tell the first year or two, but when you've been doing it 25 or 30 years, oh my goodness gracious, it's just like a true blessing to me, and I'm sure to you too. And I would just encourage people to join. I think you will do very well.
Well,
I know,
Randy, I would like to take I'll turn my camera on, even though it's dark. I'd
Yes.
like to take a moment and share. Ione and I are on a 5-month world cruise on Crystal. And I would tell everybody who know me, I have 5 businesses, but my businesses did not afford me to be on this ship for 5 months. And last year, 6 months, it was my money making money. And when I think about my family and the impact that this organization has had on my family, I don't talk about it much, especially when Ione's here, but she's not here. So don't tell her. Okay. but the impact that the information has on our thinking about everything that we do, especially how we manage our money, saving and investing. And we started with $20. And when Ione was 12, she encouraged me to let her become a lifetime member. And I think it was $500, $600, $700, $800 then. And I thought to myself, how can I have the child become a lifetime member of Better Investing and I don't become one? And thank God we did that. It no longer exists now. And just that investment by itself has been worth the investment of time and money. So I just really want to, especially as we talk about continuing to give and give and give and give and share to individuals who are not members of this organization, when the organization has provided a free membership, I just want to encourage membership. And as an organization, we're a nonprofit organization, we're all volunteers. And like Randall said, some of us have been here. I know for me, I can't speak for Dr. Cobb, but I think for me, it's probably more than 30 years now, starting with a $20 bill, and I still invest $20. And so I just want to encourage those of you who are here, you don't have to say who you are. If you are a visiting guest and you're not a member, we will put the membership link in the bottom. No, you can go to betterinvesting.org. The free membership is at the bottom of the website. It says 90-day free. And I just really want all of us as volunteers to continue every time we come on here, encourage individuals to become members. Thank you. I'll go back on mute.
She is 100% right. I'm amazed what it's done for me personally, and I've seen it do it for other people. So let's go ahead. Preston, did you put that in the chat? Did you link that?
I did. I put the portfolio
Great.
PowerPoint presentation in the chat.
Perfect. So let's go on to our stocks to review. Yvonne, do you have NVIDIA?
Hello, Randall. Yes, I do. I have NVIDIA ready.
Go ahead.
I have to say what you just went over was amazing. And what Miss McNeil just mentioned about the value of being a member of this club. I've only been a member a few years, but it absolutely is worth it. You get your money's worth. I'm going to share my quarterly stock update report. I also did a SSG. And so you should be able to see this quarterly stock update report quickly. The club now has 32 shares of NVIDIA. The average cost is $141.31. The closing price yesterday was $186.23. The most recent value line report was December 19th last year, and the most recent quarter is October 31st, meaning that January is the end of the quarter, January 30th. The last quarter sales grew at a rate of 62.5%. Last quarter earnings per share was 66.7% growth. The forecast from Value Line is for the next through 2027 will be through 2024. I'm sorry, 2028 through 2030. I'm looking at Value Line is for sales 36.5% and for earnings per share 37%. With the Value Line, with the SSG, last time I had historical sales at 30 and I kept it at 30. Earnings per share was at 27 and I raised it just a little bit to 30 because of the member sentiment, as well as with the Value Line. I felt that it was a little bit more in line. So at the
Fantastic.
current price of 186.23, the stock has a present PE of 46.2%, which is above the average of 43.6 for the past 5 years. The relative value is 106. Now I see that with Randall, the relative value was a lot higher. But here, the relative value is 106 based on this SSG.
It's the projected relative value is what it was showing on her. The next number.
Ratios. Projected relative value is 132. Okay, got it. The upside downside ratio is 2.9 to 1. It was at like 4 to 1, but now it's 2.9 to 1, which puts us at the hold range. The buy range is between 95 and 183, and the compound annual growth rate would be 17.3 to 19.8. So when I did this, oops. Okay, so I also did when I put it in better in my iClub, and I clicked on create stock watcher report. It gave some information I wanted to share with the club. So the average earnings per share growth rate expected for companies in the semiconductor industry is 5.9%. So NVIDIA is way higher than that. It's making up 11.2% of our portfolio. I think Randall said our portfolio shouldn't have more than what, 15%? Did you say 15%? So it's okay. Semiconductors make up 17% of industry holdings. So I think it's okay. The company sector technology takes up 28.5% of our total club portfolio, and Randall went over that already. So this stock represents an overall gain of 31.8% in our portfolio. I think it's doing well right now. I didn't see any red flags as I did my as I did my review, so I recommend to continue holding. It's growing at a good rate. We have a good percentage of it. We don't need any more. It's not within the buy range. It's a little bit over the buy range. No, it's significant. 186. It's a little bit over the buy range. The buy range ends at 183.8. But I don't recommend buying. I recommend holding. Do we have any questions?
Excellent presentation.
I hand it back to Randall.
Okay. The next stock to review. You have to hit stop share.
I'm going to try to do that now. Stop. I'm looking for that button that says stop sharing. I don't see it.
It's at the top usually.
Yes, usually. Recording. I'm sorry. Here it is. It's in the middle of the screen. It should stop now.
Excellent. So the next one we have here is trying to find. Is Taiwan Semiconductor. This stock is the one I said just this last week. Their earnings actually were up 46%. Percentage change in sales is 25%. So they're, just to mention, Taiwan Semiconductor is the largest foundry in the world, and nearly all these high quality chips from NVIDIA, or AMD, or the vast majority are coming through Taiwan Semiconductor. Projected sales is 26%, earnings are 20%. I redid this morning. I probably could have raised it more. I wonder if I think I might have two of these in here. That's why. Let me see if I've got another one in. Well, let's see if all studies. Yeah, I've got more than these. I've got more than this. Now, this is the one I updated. I got up to close to 20% on growth of earnings going forward and 20% for sales. It's 26 and 20% going forward here in this. Valuation, current P is 32, average P is 21, so relative value is probably close to 150. I used average high P of 28, giving you a high price of 721, low price of 170. Total returns 18, 13, very similar to NVIDIA, Hold. It's just a great company, and it is just knocking the ball out of the park. It's near its 52-week high. It's a solid hold for our club. I see it's currently we own market value of $3,000 of the stocks. So it's an excellent stock. We can go forward with Ollie from Jennifer. I'll stop sharing. Any questions about Taiwan Semiconductor first? Hello, Jennifer.
Hi, Randall. Good morning, everyone. One moment, please.
Oh.
Okay. Bear with me while I share my screen. I'm going to be sharing my SSG on Ollie first, and then I'll do the quarterly updates lists. Okay, so to start out, as we are all aware, Ollie is in the industry of discount stores. It is a consumer defensive stock, medium cap, and has a financial health grade of B with Morningstar. And they are retailers of close out merchandise and excess inventory. It sells name brand products at discount prices. As you can see, the graph is pretty much up straight and parallel, except for 2020 and 2022, which were different kind of years. It recovered in 2023, and the most recent percentage sales and earnings was 18.6 and 29.3 respectively. As we look at the fundamental company data, you can see we have a historical growth average of 12.7, earnings per share of 14.6, pre-tax profit margin of 14. I used 13 because Value Line, BI, Stock Analysis, Simply Wall Street ranged between 12.5 and 15.7 for sales and 12.8 to 17.9 for earnings. I chose 13 and 15 because I have some concerns about the evaluation of management. The return on equity is down. That has to do with they've been rapidly expanding stores. They opened about 86 stores last year, and plan to do another 75 for this year. And the pressure is coming from the rapid expansion and somewhat from the tariffs and that kind of intervention there. Debt to capital is about 24, which is still within it's up, but still within the BI guidelines, below 33. We go to the second page, and the current price earning ratio is 32.4. I went ahead and used the 5-year average of 27.1, which gives us a forecasted high price of 197.3. And I selected a low price of 90, which is, I believe, the 52-week low was 94. 80% of the current price is 93.84. So I used 90, and I felt that was within reason. In zoning, the buy zone is 90 to 116. And I want to say here that you'll notice that the upside downside ratio is 2.9 to 1. If I used, or when I used the value line projection for sales and earnings, the stock comes out as a buy. I chose to stay on the other side of that and use a slightly different because of my, again, concerns with the profit margins there. That makes the stock in a hold at the moment with a compound annual return of 11 using the forecast high PE, or annualized price appreciation of about 7, I think 6.7, using the average PE ratio. Okay. Any questions? Can you hear me?
Yes, we can hear you fine.
Yeah. Is there any questions in relation to my judgment? Can I go on?
Yes.
Okay. So, wait, let me look. Let's see. Okay, good. Can you see the screen for the?
We're still seeing the SSG, Jennifer.
You are? Oh.
Yes. You have to stop sharing first, the other one, to share that. I made the same mistake earlier today.
I was actually seeing the.
Yeah, you'll see it, but it won't show up on the screen until you stop share and reshare.
Are you there now? Can we see? Okay. You should be seeing that now.
No, I'm seeing your face now. I don't see.
Probably better than
You have to reshare, Jennifer.
I actually let me get back to the. Okay.
There you go. There you go.
Yeah, that's not what I want to share though. Let me.
Well, it's something different.
It's something different. Let's see. Better?
Yes, that's it.
Good. Thank you. Thanks for your patience. So I've written the background and I already did that background with my stock selection guide. We own 60 shares at an average cost of $80 per share. The closing price on the 16th was $118.49. The most recent value line is dated January the 16th. And the most recent quarter was the 3rd. The next report is due on the 18th of March. The latest quarterly sales was 18.6, that was 614. And the earnings per share was 29.3, which was 0.75%. Value line forecast sales growth was 13, and the earnings per share growth was 16.5. I used 13 and 15, as I said before. At the current price of $118.49, this has a present PE of 32.7. It is above the average PE of 27.1 for the last 5 years. The relative value is 119.7, which is slightly above 110. Hence another concern. The upside downside ratio is 2.9 to 1, 2.8 to 1. My recommendation is that we hold the stock. The buy range is 90 to 116.8. Where my consideration is that there's a price decline in the last few months, but we're generally up 45% since purchased in 2021. Return on equity is down, but that's due to rapid growth. They've opened new stores and additionally tariff considerations. All these seems to, because of the merchandise that they sell, they seem to be able to choose merchandise that is not necessarily poorly affected by the tariff situation. They seem to have a wide range in choosing among those. They have about it says about 10 to 50% exposure to tariffs, but they seem to be managing and have a plan to mitigate a lot of it. Despite the recent price decline, the stock performance remains strong, especially considering the significant appreciation since 2021. The expansion highlighted by the opening of 86 new stores in 2025 suggests that the company is aggressively pursuing growth opportunities, which may temporarily impact return on equity, but could drive long-term value. Investors should weigh the current valuation against these growth prospects when making the decision. Now, this note that I just read, as I was doing this, it popped up, imagining that it is AI produced, and it just popped up and I read it and it made sense based on what I read. So I chose to use it because that is my interpretation. Well, relative value is about 110%, is above 110. It is at 119. And the risk right now, the supply chain cost and selling, general and administrative expenses continue to pressurize the margins. So my suggestion is that we hold, and we watch, and maybe consider trimming. That is we own about 13% of the in portfolio. That is my recommendation, and I finish with that.
Any questions? No, I would certainly agree with you. Very well done, Jennifer Wade. Very well done.
Thank you. Thank you, everyone.
Now, in the interest of time, I'm going to try to move through a couple of these watch list stocks. Green Brick is one of the ones I follow the watch list. It's a small builder, excellent builder, but with the real estate, as we discussed earlier, being down, their fundamentals were all down. Now, I personally own the stock, but I'm going to remove it from the watch list if the real estate turns around, I'll personally bring it back, but I'm going to remove it from the watch list just in the interest of keeping the watch list just with high quality growth companies, and it's not right now. The other one I had was ASML. Now, when Taiwan Semiconductor does well, ASML does well. ASML makes the photolithography equipment that Taiwan Semiconductor purchases, and it costs hundreds of millions of dollars per machine, and they use to make the chips. Now, the other day, when Taiwan Semiconductor said they're upping their capital expenditures, I think like $56 billion, they basically said they're going to buy a lot of ASML equipment, and ASML went up. I mean, it's done very well. It's a high quality growth stock. It's very expensive. Currently, it's in the hold range right now, and with the total return using the average PE of only 6% and the high P of 9.6%. So I'm going to leave ASML in the watch list, but it's just a pure hold. If I would not purchase it at this price, it's taken off. So the other two watch lists was Mariama. Do you have Technoclass? Yes.
I believe Mariama sent an email that she wouldn't be in the meeting today.
Okay. I think we'll just leave that to later. That's another that's actually I showed you that in the sample portfolio. Its fundamentals are down a bit, but the last year earnings are good. So we'll just leave that in the watch list. And the other one was Jennifer with NVMI. Do you have that, Jennifer, by chance?
No, I'm going to pass on that today. Randall,
Okay.
just basically, I can give information in terms of when we added it, but beyond that, I haven't done a whole lot of research on it.
Okay, that's fine. It's just on the watch list. It's not one of our portfolios.
Yeah.
Yes, go ahead.
I may have done the SSG and sent it out, but I didn't it didn't complete that process. But we've added it to the watch list in May of 2025, and the price was $191.77. Currently, it's $394.07, which is an increase of 105.49%. I mean, it has always been a hold, and we have not purchased, but it's currently a hold based on the SSG done. And
they're selling the products to the AI? Is that why they're?
Yes, they're located in Israel also. And I think and so it has been on hold. We've not been able to make a buy decision. It is on a hold due to the valuation, I would think, more so than anything.
Yes. Okay, very good, very good. So let's go. Does anybody wish to discuss either purchasing or selling any of our portfolio? And if so, what would somebody like to discuss?
Well, I think we talked about trimming Alphabet. I don't know if anybody's in favor of maybe starting with that, since we're at 19% and the goal is to have around 16%. But again, it's been like you said, it's one of our winners. And do you want the winners? Well, like that quote from
Peter Lynch,
Peter Lynch. You're gonna trim your flowers and keep your weeds, but I don't know. We won't know until a couple months later if we put it into something that gives a better return or diversifies our portfolio a little bit or meets other of the criterias that we looked at in the portfolio review. It might be beneficial.
Well, it's at 19 versus 16, so it's not like it's 30% versus 16.
All right.
I think even more importantly is we have to make a decision on Chipotle, honestly. And whatever the club wants to do with it, it's fundamentally doing poorly.
Can
Do we want to
we
sell all that and put it in something else?
can we do a comparison of Chipotle to Vital Farms?
Oh, I think I can do that. Give me a second here. Let's see. They're kind of different industries, so it's kind of hard to compare, but I'll go and do that. So we go to stock comparison guide. Y'all are seeing my screen now?
Mm-hmm.
Okay, so we want, let's see, CMG. That's our CMG, and here's, I think it's VITL. Yeah, There you go. So, Christian, you want to, I mean, in this, go ahead. What are your thoughts?
Vital Farms, okay, Chipotle is a consumer defensive or consumer discretion? And same thing, question with Vital Farms. Do we know what sector they're in?
So Vital Farms, I know, is a consumer defensive.
Defensive. And I believe, okay, and then so I believe Chipotle is a consumer discretion.
Yes, I think you're correct.
And then the fact is that we're Vital Farms is looking good, and we're only 1.4% of the portfolio. We talked about either get rid of it or add more. Sounds like we want to add more, but and then Chipotle would just have to do the analysis to decide if it's because it's also still in the buy, but it's just been a little bit of a laggard over the years. I mean, over the months.
Well, the fundamentals are poor. That's the key on the quality, is to look at the fundamentals. I mean, it can turn around, but fundamentally, the last few quarters, it is not performing. So no matter what the price, it may show up as a buy, but maybe a value trap. But I mean, if you could just compare these two, sales growth is much higher in Vital Farms. Earnings per share is much higher, although 10-year, although Chipotle is nothing to shake out about. Pre-tax profit is higher in Chipotle. They're both buys, although I said Chipotle is a fundamentally poor company right now without change around, but the compounded annual return looks better in Vital Farms. I mean, so.
And Chipotle is large, and we're needing more small. So
even better idea. Yeah.
I would be in favor of selling all of Chipotle and putting all the proceeds into Vital Farms.
Do we have a second?
Second, Ann McNeil.
Okay. Let's have anybody want to discuss that further. I think that's a good idea. Any
Can we what would the math look like? So
currently we have in CMG, we have $1,198, $3,100.
Okay.
And we would just roll that into Vital selling for $29. So that's 30 times. We just we'd all put nearly $1,200 into Vital Farms. I could do that Monday easily, no problem at all.
Perfect. So let's do it. Let's sell all of Chipotle and put all the proceeds, however many number of shares that equals at market for Vital on Monday.
But you have
yes, go ahead.
You have a motion and a second. You have to just call for the vote of the members first.
Okay, let's have a vote. All those in favor of selling all of Chipotle and putting the cash returns into Vital Farms, say aye.
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 All those opposed? Okay, that carries. We will sell Chipotle and we'll buy Vital Farms.
Randall?
Yes, ma'am.
Can we also discuss, for the same reasons that Jennifer mentioned in her update, to trim a little bit of Ollie? based on what she said is we have, the shares we have is an average cost of $60 and it's now at 119. So it's actually, some of the shares that we have actually doubled in value. So, could we consider, based on the discussion that Jennifer had with the concerns she had on management, we could trim some of it?
I've got her SSG in here. I'll just flip it back up. This is
What's the
Jennifer's
percentage
SSG.
we have of Ollie compared to the and what sector is that?
Defensive.
It's
Consumer,
consumer
consumer
defense.
defensive. We could
Okay.
compare it to Vital Farms. They're in the same. But that's what we're going to be looking at buying.
Yeah, the cost basis was 4808. Market value is 69.96. So we've gained $2,188. I think we purchased it maybe different times. At sometimes we bought it was a great time. Sometimes we bought it maybe was more expensive, and that's why we have the gain of only $2,188. And that was from a starting block of 4,800. So, it's up, 45%, as just what Jennifer said. But the market's been up more than 45% since 2021. So it has underperformed the market.
Because of 2022.
Yes,
primarily.
that's right. Yeah.
And it came back in 23. But we could trim. I would be in favor of trimming, but it's just, I wouldn't take it down less than 10%. So
What's the percentage of the portfolio? Ollie's is what percentage of the portfolio?
Give me a second. Look at
13.3.
Okay. Yeah, 13.3, just like Jennifer said. So we have 60 shares.
Mm-hmm.
I mean, so Kristen, what is your thought?
I would say we hold off till table this till next meeting and revisit if we can put it.
Yeah, I think with the PERT, we can revisit quickly and easily all these companies, much easier.
Yeah.
Yeah, if we get used to it, it's not going to be easy to start with. But yeah, I think that's a good idea myself.
I'm not opposed. Let's just let this purchase settle. Let's reevaluate the portfolio, meet next time, and then revisit this exact decision of whether or not to trim some 10% of Ollie's.
Yeah, I think it'd be great.
Agreed.
Okay. Well, this is the time of the meeting that we would like our guests to come off mute and discuss what we've done well, what we've done poorly. What are your thoughts? I saw Steve Emmerich was on earlier. He's from the Heart of Illinois Club. I don't know if he's still on now, but guests come off and say hello.
Hi, this is Zelda Okia. I'm in the Milwaukee area. Off camera, recovering from COVID. So great meeting. And thank you for giving me an opportunity to ask my questions. So yeah, looking forward to a interesting new year.
Anyone else?
Thank you.
Mm-hmm. I see Barbara Larson's on. Do you want to make any comments, Barbara?
Hi, this is Jewel Player.
Yes.
There are quite a few of us from our investment club. We're just now getting things up and running, and so we thought we'd sit in to get an idea and see how your meeting is run. We are members of the Better Investment, and we're just excited to finally get things off the ground. We had a few hurdles last year in trying to get things started, but now we're ready to move forward. We're located in Fort Pierce, Florida.
Oh, great, great. My stepson lives in Vero Beach. So, well, we would say starting the club is the hardest thing. So you probably got through the biggest hurdles already, honestly.
Yes, at least we have our core membership, but we're ready to really move forward this year.
Great, fantastic.
Yeah, I just want to make a comment. Julie, you may want to contact the president of the club and ask for a club visit.
From your
Thank
chapter
you.
here. Yeah.
Yeah.
Well, great meeting, Julie.
Okay, you mean the president of the chapter? Which club are you speaking of?
Yeah, our chapter.
Okay.
Right.
Yes, we did talk with her. We had a Zoom meeting with her Monday night too.
Okay, perfect. So she's probably did it already. All right, thank you. You're right on track. Thanks.
And tell Ayani worked with us last year in helping us, get things started. So you can tell her we're finally moving forward.
Great.
Absolutely, will do. Thank you.
Anyone else? Okay, well, our next meeting is February 21st at 6 p.m. Group 2, you'll be presenting the education and the stock. And so be sure to be prepared. I'll send you an email today. But I thank everyone for being here. I hope you had a wonderful holiday season and a very happy new year.
Thank you.
Everybody. Thank you.
Happy next month.
Thank you.
Thank you.
Thank you.
All right.
Bye-bye.
Bye.
Bye.